Okay, good morning.
Good morning, Stephanie.
How are you?
Fantastic. And yourself?
I'm great. Thank you so
Good.
much for taking the time to do this call with me. And the purpose of the call is to educate our viewers on the pre-approval process when they're
Sure.
looking to buy a home. So you as a lender, professional in your lane, I thought you would be a good person to speak to and share the information. So just let me introduce myself first, and then I'll let you introduce yourself. My name's Tiffany Matthews. I'm a realtor with Next Home Leaders. That's here in Pikesville, Maryland. So Charles, I'll let you introduce yourself.
My name's Charles Wilson. I'm with Draper and Kramer Mortgage Corporation. Draper's been around for about 105 years out of Chicago, Illinois. My office is located in Tysons Corner, Virginia. I also have an office in Rockville, Maryland. I've been doing mortgage loans for over 25 years.
Perfect. Love all of that experience for sure. So let's just dive right into it. The market right now is really hot, especially for buyers, because the interest rates are really at a all-state low. So tell us basically, for those who don't know, and I'm sure everybody does know, but what is a home loan?
Basically, a home loan is a loan where the lender qualifies a borrower to purchase a property that has land and a property on it, land and a building, because some people get mixed up that you can just buy a lot. But a mortgage loan is based on land and having a property on that building. And what it is, it's an agreement between the lender and the borrower for the buyer to purchase that property and agree to the terms and conditions thereof, having a mortgage payment, paying the mortgage on time. And if not, the lender has the option to come back and foreclose or take the property back.
Okay, makes sense. So what is like the first step to getting a pre-approval, and what is a pre-approval?
The first step is to get qualified so that you can know, number one, where you stand as far as your credit, your overall position, your overall situation. When you go to get pre-approved for a loan, pre-approval and pre-qualify being the same thing, you want to make sure that, number one, we go off your income. What's your income per year? Another thing we offer is, what is your credit like? What's your credit score? How have you paid your bills on time? Are there any collections, any judgments? All those things taken in consideration. And then we want to know about your debt. We want to know if you have any student loans, if you have a car payment, any credit cards. Is there any child support, any alimony, anything that impacts your monthly payment? We want to take all those items on a monthly basis that you pay. We take your income that you receive on an annual basis, and that can include income for your work. It can include retirement income. It can include Social Security income, disability income, or any other income that we can prove that you get consistently on a monthly basis. So we then take your total annual income divided by 12, whatever that figure is. We take all your other debt along with this new mortgage payment. So let's say you're going to purchase a house for $150,000 and your monthly payment is going to be $1,000. Well, we add that $1,000 to your debt, and then we divide that into your overall monthly amount of income that you receive. That tells us your debt to income ratio. That tells us what you're qualified for. The normal basis is you have to be qualified for 45% of your debt ratio. So those numbers tell us a true picture of what you can actually qualify for.
Okay, and that's really important because, it's like you said, it's not just based on your credit score, it's also looking at the income. I know I've had several clients who have a wonderful credit score, but the income may not be exactly where it needs to be. Now, to piggyback off of that, when you're looking at income, how far back are you going? Are you looking at 1 year, 2 year?
2 years.
What 2 years?
We're looking at 2 years, and the reason that we look at 2 years because sometimes 1 year is not enough. 2 years gives us a good average. 24 months of you receiving that income lets us know that it's been consistent. And in some cases, the borrower may have had one job that they've started for a couple of months. It may have been a new job. But we also can go back to that previous job because we need 24 months or 2 years of income in order to qualify you as a wage earner. Now, if you are self-employed, the same rule applies. We need to see that you've been self-employed for 2 years and have filed your tax returns for 2 years, because sometimes the first year may not be as good of a year. So with doing two, hopefully you can blend those 2 years in and come up with an amount of income that will better qualify you for the loan.
Which definitely is to help the buyer. So,
Exactly.
Exactly. Perfect. So how long does it usually take once the person has submitted their information to you to get that pre-approval?
It varies. So in a lot of cases, if the borrower has submitted the main documents needed, the W-2s for the last 2 years, 30 days worth of pay stubs, last 2 months complete bank statements, an ID, driver's license, passports, so be it, and proof of monies to close, where that's going to come from, usually within less than a day, they can get approved or pre-approved to know exactly where they stand. If they're doing a grant program, that might take a little bit longer, because now instead of just needing W-2s, now we need tax returns for the last 2 years. And we need to prove that the tax returns have been filed. We also need to prove that if there are any other residents that live in the house, anybody else living in that same house, we got to count all the income in that house, not just the people or the person on the application, because the grant administration goes off of total household income. So some people don't qualify because there might be another person living in that house that makes more money, and it's adding to that overall number, which knocks them out for being qualified. But if they're not doing the grant program, if they're using their own money, usually within a day or less, they can get pre-approved in the way stamp.
Okay. That leads me to one more question that I forgot to ask. So you had mentioned previously, when determining how much you're going to be approved for, that you're looking and pulling all of the income that you can actually prove. So I do have clients sometimes who are married, but the spouse may not be on the loan. The one spouse is going to be the person applying for the mortgage. But of course, you know, they have that additional income from the spouse. Can you count that?
When you say additional income from the spouse, meaning like to go towards monthly bills?
Yes. But they're not going to be on the. They're not going to be on the primary loan.
In most cases, no, because they want to see what you get from your job, or like say if you get Social Security or disability, or retirement, there's always an awards letter to accompany that. So that's what we use as proof. A lot of time, if you're just getting income from your spouse, there's no way to prove that you're going to be getting that consistently for a certain period of time. And that's why it's hard to use that income.
Unless they get on the mortgage with you on the loan.
Exactly.
Okay. Great. That's just clearing that up, because sometimes that happens, and you know, it's unfortunate for people because they know they have that income coming in, but for whatever reason, the spouse is not going to be, you know, as a co-person on the mortgage. So,
well, usually when it's a case of income qualifying, usually there are some workarounds, and it depends on what's going on. Like say, sometimes the wife and the spouse might have a car loan. She may have co-signed for him, but he may be the one making the payments. So if we can prove that he makes the payments on that car loan for 12 months, even though it's in her name, we don't have to count that debt against her, which will have her having a better debt to income ratio, if that makes sense.
Yes, that makes perfect sense. Okay. So tell me, what's the time frame that you recommend for someone going ahead and starting this pre-approval process before they actually start looking to buy the home?
As soon as they make up their mind that they're ready to purchase a house. And the reason why I say that is because sometimes there are things that may be on our credit report that we have no idea about. They may have popped up or may have been there, and we need to deal with that first. So we need to know, what does our credit report say about us? What are our credit scores? What are our bills? Have there any lates on them? So we need to know all of that up front, because if we wait until we're ready to go out and look for a house and they pull the credit and the credit is not doable, then we got to start at that point to see where we at. As opposed to starting down the road, you get a good picture of where you stand, you get pre-approved. That way you have a letter, and if you want to take 6 months or whatever to come back, at least you know that you're pre-approved, and all it will take is reissuing updated documents and a pull of the credit report again.
Okay, so we're thinking maybe 6 months before you actually are ready to purchase. Go ahead, get with a lender to get pre-qualified, see where you stand with the credit, and go from there.
Yes, that's a good rule of thumb, unless you're purchasing a house that's of great magnitude. When I say that, 300, 400, 500,000, you know that you need to save some money. You may want to start a year in advance and say, okay, well, I want to make sure I put myself in position so that when next year comes, 2 months prior to me vacating the property, because normally you need to give the landlord, if you have a landlord, you need to give them 2 months before you're ready to move, that you are going to be moving. And if not, you're going to be signing that lease all over again. So you want to make sure that before you go on a contract, that you're qualified and that you feel comfortable in telling that landlord, I'm not renewing my lease, then I'm moving. So in order to do all that, you've got to have all your ducks in a row. You got to have a pre-approval letter, and you've got to have a property in sight. That's why I said, if you're saving money, you want to give yourself a good cushion so that you can have enough money to make you feel comfortable about having the down payment and or the closing cost that's needed.
Gotcha. So speaking of down payment, typically right now, what we can speak to, what typically is your down payment amount? Let's just say with the FHA versus conventional.
Usually, with FHA, the down payment is 3.5% of the purchase price. So if the purchase price is $150,000, $5,250 is the amount that's needed as a down payment. Now, the rest of the closing costs would come depending on if the seller contributes towards a closing cost, if the lender was able to give you a gift towards, or a lender's credit towards closing costs, or were you paying that amount out of your pocket. Now, as far as conventional loans, well, let me just go back. So for FHA loans, minimum score 580. You have to have at least a 580 credit score in order to qualify. Now, with conventional financing,
is that with all lenders, or is that just with your company?
No. Well, that's with only some lenders. It's mainly with most direct lenders. There's some exceptions to the rule. But with conventional financing, you need to have at least a 640 credit score in order to qualify. And with that in mind, instead of having to put 3.5% down, you only need 3%. Now, the caveat to that also is, if you already own a property, whether it's FHA or conventional, if you're purchasing new again and it's going to be a primary home, you have to have 5% down, whether it's FHA or conventional. And if it's an investment property, it's 20% down.
Okay, that's good to know. 20% for convention investment. Okay, so I'm just going to recap that. So for FHA with your company, there's a score, credit score of 580. It's a 3.5% down payment. For conventional, you have a score of 640 with a 3% down payment. That's if this is going to be your primary purchase, first purchase, correct?
That's correct.
Okay, and if you're making a second purchase, let's say a second home, vacation home, either of those is going to be 5% down. Correct?
If you, yes.
Okay.
That is correct.
And if it's an investment property that you're purchasing, with either of those, it's going to be 20% down payment.
That is correct.
Okay. That's a lot.
Well, once the buyer gets with me, I'll inform them and let them know everything that's needed.
Exactly. And you don't have to know all of this stuff. The point is just to provide some information, education, so you can kind of get a general idea of where to start and who to contact, i.e.
Exactly.
myself or Charles.
All righty. That's it.
All right. Now, what programs do you that your company works with so far as first-time home buyers to assist with, down payment?
Well, there are several programs, but the main ones are the Maryland Mortgage Program, which they will offer you 3% or 4% towards your closing costs and down payment. At 3%, the rate would be 3.625 typically. At 4% help, the rate would be 4.625%. So I normally would tell the agent or the buyer that consider purchasing without the grant program if you can, because at interest rates based on where they're at right now, they're in the mid to low 2%. Mm-hmm. So if you can get in at 2.25 or 2.5% with using your own money, that's more of an advantage than you using the grant program to get an interest rate that's 3.625 or 4.75 to get money towards your closing, if in all possible. Now, in some places, the borrowers need that grant money, and if that's the case, please, by all means, go ahead and facilitate that. But I'm just saying, if you have the option of doing the financing without those programs, that would be the advantage. Lower interest rate, and with the lower interest rate, if the buyer would make one additional payment per year on the loan, usually when they file their tax returns, that would reduce the time that they have to pay the loan off, usually about 7.5 years. So a 30-year loan would actually be paid off in about 21.5 years.
Oh, wonderful. That's a really good nugget right there. Just making one extra payment per year saves off about 7 years?
Yes.
Wow.
Mortgage is based on time. So when it's paid before it's due, it cuts off the amount of time that's owed on the loan.
Wonderful. Now, if you do a grant program, I know, and we don't want to go too deep into this, but I know some of them, they do have stipulations so far as it being forgivable and how long you have to stay in the home to keep that forgivable loan. Is your program something like that?
Usually with the Maryland Mortgage Program and the Pathway to Purchase Program, well, let's start with the Maryland Mortgage. So that program, it's a second mortgage that gives you the amount of money that you need towards closing. That money is kind of like in a kitty. That sits there for 10 years. After 10 years, it's forgiven. But keep in mind, when you're making that payment based on the rate being 3.625% or 4.75%, you're actually, in essence, paying that loan back in your monthly payments over a period of 10 years. So after 10 years arise, there's no more need to have a lien on you as far as that's concerned, so they release it, if that makes sense.
That does make sense.
Yeah.
What about the refinance piece to that?
Period, or to that particular scenario?
Just to that particular scenario. Is that possible?
Sometimes it is, sometimes it's not. It depends on the lien holder, because in order to refinance and you have a first and a second, the second would have to agree to come back behind that first and do the loan or hold the loan. So in some cases, in most cases, when the lender knows it's a benefit to you, they'll do it. But then sometimes, like say for FHA, it's more widely accepted than it is for conventional. And I explain why. Once you're approved FHA, you're approved period, unless you're going to do cash out. If you're just refinancing and get a better rate, they're considered a mini or a streamlined refinance, which will allow you to refinance without an appraisal, without an tax returns, W-2s, pay stubs. You don't need any income docs in order to refinance and put yourself in a better position. Differently than conventional financing, whereas though anytime you come back and refinance after you purchase the first time, you must and you have to do an appraisal. No questions asked. So when you do an appraisal on conventional, if you don't have the loan to value in the appraised value, then it's going to be hard for that loan to be approved. So that's why I said it's more widely done with FHA financing than it is for conventional.
Okay. Makes sense. Now that might have been a little bit too much for a lot of people, but that's okay.
And again, I'm just sharing with you, but I'll break it down
Yeah.
once we get a chance to talk.
Yeah, absolutely. So if you were to sit down with somebody and that was kind of the scenario for them, you would break that down so that they understood
And
exactly.
basically, I would say to them that if you have FHA, it's more likely for you to come back and refinance that loan down to a lower interest rate with a grant program than it is for you to do it if you did conventional financing with a grant program.
Great. And what I want people to take from that basically is that if you need assistance with your down payment or your closing costs, and the grant is the way to go to do that for you, you can do that, and you still can skin the cat later on down the road with a refinance if you're making on-time payments after a 6 month or greater period to refinance and get that interest rate lower.
That is correct.
Okay. So we've talked about a good bit of things here. I just want to sum it up here for everybody. Basically, the best thing that you can do is when you know you're interested in purchasing a home, the first thing you should do is to reach out to your realtor. Your realtor is going to be able to get you in contact with a lot of different connections. That's going to be lenders. That's going to be information on grant programs, what the market looks like right now. After you've been able to sit down with your realtor, that's when they're going to recommend you to a lender, have you sit down with the lender and get that pre-qualification, pre-approval process started. Started as soon as possible, right, Charles?
Absolutely. Absolutely. And again, one of the keys to successful home buying is starting up front to get qualified, because nobody wants to go and purchase a house and get out there and run into all kind of nightmares. And the way you avoid that is to take your time to get qualified properly first, get all your documents in place, get pre-approved properly by a good lender, and then once you go out with your agent, it's a much smoother process to you getting to the finish line.
Absolutely. I would agree with that 100%, because that can make or break a realtor really, and getting additional referrals and being able to work with that client, because if they're having to go through so much up front after they found the property and then find out down the road, oh, I don't actually even qualify for this property, they're going to be mad, and they're probably going to be mad again. The realtor.
Well, hopefully there's a workaround.
Yeah, well, I have you in my corner, so we know the right way to do this process.
Absolutely.
So anybody that I work with, I always try to go ahead and get them in the know. It's better to know up front and be proactive versus being reactive. So any final thoughts from you, Charles, before we wrap up?
Well, I mentioned about the purchasing and getting qualified up front, but now today there's so many borrowers looking to refinance because rates are at a astronomical low. Rates right now are at 2.25%, 2.5%. Being able to refinance, take out money to pay off bills, do home improvements, or just put yourself in a better position to lower your term. A person could lower their 30-year term down to 15 or 20 years and not pay much more than they're paying now because of the interest rate being lower. Absolutely. So that's a good takeaway for right now, with rates being low, industry low. And I love to help anybody. Again, my name's Charles Wilson. I'm with Draper and Kramer Mortgage Corporation. My phone number, my direct line is 410-963-5992. My email address is charles.wilson@dkmortgage.com.
Wonderful. Thank you. Thank you so much for taking out the time to educate me and educate my clients that I work with. And again, my name is Tiffany Matthews. I'm a realtor here in the Pikesville, Maryland area. I do cover surrounding counties in the Baltimore, Maryland area. So if you need to reach out to me, I can be reached with my direct number at 478-718-1004. My email address is Tiffany, Tiffany, at nexthomeleaders.com. We thank you guys for taking out the time to listen to us. If you have any questions at all, please don't hesitate to reach out. We'd love to help you.
Thanks again.
Thank you, Charles.
Okay.